All right. Hello, everyone. My name is Praphul, and I'm the founder of Koinearth. I'm here to talk to you about how blockchains can be used in enterprises and how you can understand the technology behind it, as well as the transformational business impact you can use it for in your organization. So, the agenda for the workshop today is that by the end of the next 45 minutes, you should be able to answer questions like what a blockchain is, what is its importance in the digital enterprise, how is it different from a traditional database? And where all can you consider using it in your organization? The best way to understand blockchain technology is to go back to the beginning, where this technology came from and why was it invented. And the story of this technology starts in 2008. As many of you may remember, 2008 was the year of financial crisis, which started in the Wall Street and then spread globally. This was the year that saw the downfall of many large financial institutions and also was a time of extreme distrust in financial institutions. And it was in this context that this paper came out, Bitcoin, a peer-to-peer electronic cash system. What was this problem? What was the problem that this paper was trying to solve? Well, given the huge mistrust in financial systems in 2008, the problem that this paper was trying to address was how do you create a form of money or electronic cash which can be sent from one party to another without going through a financial institution. First, let's understand why this paper came out at 2008. As I mentioned, 2008 was a year of great mistrust in financial institutions because of the financial crisis. So that is the context in which this paper is being written. Right? And why is this problem important? Well, if you think about it, any monetary transaction today between two parties must have a financial institution or bank in the middle. So if any two people want to transfer money from one to another, they must do it through a bank, whether it's Beam or UPI or a bank transaction, NEFT, RTGS, credit card, debit card. There's always a financial institution in the middle. And what this paper was trying to solve was, can we do this without requiring a financial institution to make? Now, it turns out that this is a fairly hard problem, which had been attempted several times in the past, but had never really been solved well. Right? And this paper solved this problem using a combination of three technologies: digital signatures, transaction hashes, and a unique way of storing records of transactions. Right? To understand how this paper solved this problem, we go one step back and ask, what is money? Right? I'll give you 10 seconds to think about this. We usually don't think about what money is in our day-to-day lives, but it is a good question to kind of think about for a moment as to what money really is. Right? And if you have thought about it, let me now show you this picture to trigger your thoughts even further. And I want you to look at this picture and ask again, what is money? Okay. Specifically with the picture on the screen, I want to draw your attention to the statement here, which says, I promise to pay the bearer the sum of 100 rupees. And it has been signed by the governor of RBI. And I want you to now also think about, what is this promise? What is it that is being promised to you? And what will really happen if you, as the bearer or holder of this note, present this note to the RBI governor? What will you get back? Think about it for a few seconds to kind of understand what money really is. Now, a lot of people are under the impression that if you give this 100 rupees to the RBI governor, then you will get gold worth 100 rupees. Now, this statement was true in the past, but in the last half a century, this statement is now false. Nowhere is the word gold mentioned on this promissory note. And in fact, if you give this 100 rupee note to the RBI governor, he will just give you the note back. And this also again makes you think about what money really is. And if you think about it, you will realize that money is a human creation. And we created money to enable trade between people, because barter did not scale. And that is why money was born as a medium of exchange. Very quickly, it became a standard of value. And with the advent of banks, it became a store of value. Perhaps the most important part that I want to cover in the first 10 minutes of the workshop today is that money and cash are two different things. What you see on the top is a representation of money in a physical form, and that is what we call cash. And if you look at the picture on the right, this is the total amount of monetary supply in the world. You will realize that at the bottommost blue mountain, if you see the bottommost blue mountain, this is the total amount of cash in the world, and the total amount of money in the world is much larger. So money supply is much, much larger than cash. Cash is just the physical representation of money. And even though cash is physical, most money today is just bits of information. And money exists today only as an entry in a bank ledger. Once you understand that, and with that perspective, go back and re-examine what this paper was, you realize that to solve the problem, to create a money system where money can be sent from one party to another without going through a financial institution, what you really need to create is a new kind of ledger, right? Since money is just an entry in a ledger, to create money is to create a ledger which is not controlled by banks. That was the original purpose. You wanted to create a monetary system which is not intermediated by banks or financial institutions. So the problem statement is now transformed to saying, can I create a ledger not controlled by banks? The $1 million question then came up, if you have to create a ledger which is not controlled by banks, then who should control this? And we didn't want any single party to control this, because otherwise you would be back to the original problem, centralization of too much control and power with a few financial institutions. And the answer that they came up with was that no one entity should maintain this ledger. Another way of saying it, multiple entities should simultaneously be responsible for maintaining this ledger. And it was this thing that they created, a public ledger which was not controlled by anyone, but was maintained jointly by a bunch of peers or nodes. And this distributed ledger came to be known as blockchain. So the money that they created was cryptocurrency, which was Bitcoin, and the underlying ledger which they created to create this money, to store the accounts of this money, to store the transactions of this new kind of money was the blockchain. So what the bank ledgers are for money, blockchains are for cryptocurrencies. So with what they had done was the traditional financial system where money was created by entries in a database, which were owned and operated by banks. The paper ended up creating a new form of money where the ledger was not controlled by any single entity, but was a public ledger where anybody could join and help maintain it, and therefore there was no need for an institution. So that is really the history of this technology. And once you know the history of the technology, then when you hear the definition of blockchain, it makes sense. A blockchain is a public ledger or a database which is maintained jointly by multiple entities to record cryptocurrency transactions. Right? One of the underlying properties of the technologies is that all ledger copies are synchronized in almost real time. And finally, to ensure that the security and the authenticity of the data being recorded, they used cryptography and digital signatures. So all ledger transactions were digitally signed, verifiable, and non-deniable. This then is the first definition of blockchain that you must understand to then further go down the path and see how this can be used in enterprise settings. So this is the birth of blockchain technology around 2008 to 2010 is when this is being done. A few years later, around 2014, one big transformational impact that happens is that we take the definition of blockchains and strike out the word cryptocurrency transactions. So we say, okay, here is an interesting technology. Here's a public database maintained jointly by multiple entities. But why should we use it to record only cryptocurrency transactions? Why can't I record other kind of transactions on this public, secure, multi-node blockchain network? And that really sees the emergence of new kind of use cases in this era of blockchain 2.0, where different transactions are stored. So for example, you could potentially record on this blockchain ledger or blockchain database transactions regarding land, transactions regarding vehicles, right? So for example, just like cryptocurrency is an asset, you could treat a land or a car as an asset and store on the blockchain ownership of that asset and the transfer of that asset from one party to another. Right? So this is about 2014 is when this starts to happen, when the blockchain technology starts to kind of break away from crypto. Now, a couple of years later, blockchain 3.0 starts to emerge. And the fundamental difference between 3.0 and 2.0 is that the word database now is replaced with a digital platform. Now, for those of you who've come from a technology background, would be reminded of how databases were initially created to be data stored, and then stored procedures allowed them to become execution engines. And something very similar happened in the blockchain world, where this technology was initially designed as a public database, which was maintained jointly by multiple entities to record any transaction. But then this was expanded to make it a true blue digital platform. And this was achieved with something called smart contracts. And perhaps the best way to understand smart contracts is by thinking of conditional transactions. What do we mean by conditional transactions? Well, let's first talk about what we mean by transactions. A transaction is simply a transfer of value. So when A pays B 100 rupees, we say a transaction has occurred. But you can now convert this into a conditional transaction, saying A promises to pay B if something happens. And this statement is now a conditional transaction. And the conditions for the transaction can be programmed by solution developers and application developers. And once you have a technology which can do this, which can record conditional transactions, where the conditions can be programmed, you have converted a blockchain from a public database to a public digital platform. And that's why in 2015, economists called this the universal computer. What they were talking about is here was a technology where you could have contract enforcement without manual intervention because the conditions of the contracts could be programmed in. And once they were programmed in and stored on this public digital platform, then they were guaranteed to execute. And this is what you would see when people are talking about trust in public blockchains. That's what they're talking about. The ability that two parties, in this case, the green and blue party, can actually enter into a contract with each other. And the underlying platform using smart contracts and digital signatures and distributed ledgers ensures that the contracts will be executed without manual intervention. That is really the power of smart contracts. And this started to emerge around 2015-16, blockchain 3.0. A couple of years later, we saw the emergence of the next step in this journey, blockchain 4.0. And here the focus was on removing the word public and replacing it with shared. Right? Here the idea really was that why does the network or the database, which is a distributed database, need to be public? Can we create a private or a permissioned version of this? And you can see why this might be attractive to enterprise blockchain scenarios who may not want to store the kind of sensitive data that they deal with on public ledgers. And what you saw with Enterprise 4.0 was the emergence of what we call enterprise blockchains. These are permissioned networks. They are still everything that is in the definition of blockchain still holds. It's a digital platform maintained by multiple parties. All copies are synchronized. Transactions are digitally signed. Ledgers can record conditional transactions and smart contracts. But these are private instances of blockchains where not anybody can come and join these networks, but only they can be joined. They can join the network only if they are allowed to do so or invited to do so by enterprises which are creating these networks. Why would you want to create such networks? Well, because once you can create a private blockchain or what we call a permission blockchain or an enterprise blockchain, then you can allow secure cross-enterprise collaboration. And that really is the starting point for how this technology can bring transformational impact in your organization in an enterprise setting. The best way to think about enterprise blockchain is to consider them to be cross-enterprise digital platforms. What do I mean by cross-enterprise digital platforms? Let me leave that screen up, with this screen up for about 30 seconds and let you stare at this. No matter which industry you want to pick, depending on which organization or which enterprise you belong to, you will realize that you rely on multiple entities outside your organization to serve your customer and generate revenue. For example, in the automotive industry, a car manufacturer may rely on an insurance provider, a bank, a supplier, a fleet operator, and even logistics providers. There can be many, many entities that this OEM might rely on. In the case of healthcare, you have pharmaceutical companies, you have hospitals, you have pharmacies, and of course you have patients. And all these entities need to connect with each other. And think about the power of a digital platform which connects such entities. What would that mean? And the really big impact of such cross enterprise digital platforms is the way we think about data. Now, most companies today understand that data is an asset. But in the blockchain world, it is best to think of data as a shared asset across enterprise boundaries. So when you are able to create a cross enterprise digital platform like the one that you see on the right now, imagine for a moment that this is your organization and these are some of your business partners that you work with, other companies that you work with closely, maybe your logistics providers, your banks, your suppliers, your channel partners, no matter who. Once you are able to create a cross enterprise digital platform, then data can really become a shared asset between these enterprises. Now, why is that powerful? Well, depending on which industry you are, this statement can have multiple meanings. For example, if you are a manufacturing entity, then imagine the power of having visibility into the inventory data of your tier 1 and tier 2 suppliers. Not only that, you can then combine it with analytics and machine learning to share not only inventory data, but forecasts of inventory and demand. If you are a bank or a financing company or a fintech company, imagine the power of being able to access authentic transaction data records of your enterprise borrower, which will allow you to create a much better risk profile and evaluate the risk before lending. And you can, of course, extend it to say that I will build projected cash flow models and risk scores on top of it. If you are an insurance company, then the ability to access asset data, usage data, and health data can be a very powerful incentive for you to build such cross-enterprise digital platforms. That really is the way to think about blockchains, enterprise blockchains, cross-enterprise digital platforms, and its impact on how data is treated as an asset. So this is where we come in, right? For example, to give you, as I mentioned, I'm the founder of Koinearth, and here is an example of what we have done with this technology to make this real for you. Our platform markets, and which is an enterprise blockchain scenario, enables you to create secure, private B2B groups, right? So the cross-enterprise digital platforms that I was talking about, we call them simply groups, right? So for example, you can form a group with some 7 of your suppliers. Maybe you form another group with your channel partners. You form one group with a bank and some of your tier 1, tier 2 suppliers. So you can form multiple groups. And this will kind of remind you of what you see in WhatsApp, the ability to form these groups. But of course, these groups are between companies and not individuals. And underneath the hood, these groups are actually permission blockchains between those companies, right? You can have multiple groups and data is not shared across groups. That's where the data privacy angle comes. So that is the first thing that you can think of, the ability to create such groups, which I was calling cross-enterprise digital platforms. Why are they platforms? Because not only can you share data among these members inside the group, you can actually have smart contract-based workflows to coordinate operations between these groups. These operations may look like P2B transactions, they may look like insurance contracts, they may look like procurement operations, any kind of things that you can think about where enterprises deal with each other and transact with each other. And what the platform really enables is real-time B2B coordination with shared visibility. Here is another example of how blockchains can be used in enterprise. This is a recent solution that we released after about a year of work, which we call NFTs. Now, you would have heard a lot about NFTs. NFTs stand for non-fungible tokens. Right? They are another kind of asset which can be recorded on the blockchain and transacted on the blockchain. A lot of press has covered NFTs with relation to digital art. But what I'm going to talk to you about are enterprise NFTs and why they are powerful. So what we have done is created the notion of a product passport with enterprise NFTs. For example, here is a passport for a vehicle, for a car, right? Now, I will bring your attention to this part. You will need that this is a passport which is shared between you as an organization and three other organizations. Remember the notion of cross-enterprise digital platforms which show up as B2B groups, right? Now, why would you want to have a product passport shared between multiple organizations? Well, for one thing, it improves customer experience because now you have a context in which to share data. The product passport becomes a context in which these 4 or 5 organizations are sharing data with each other. So for example, you can have the product passport can enable, in the case of an automobile industry, sharing of product specific data between manufacturers, financiers, insurance providers, and service providers. Right? So bringing a lot of transparency, visibility, and improving the customer experience. The second thing that the product passport can be used for is to create a certified auditable trail of the history of the product from the cradle to grave. Why is this important? Well, for one, it improves the resale value of the vehicle because once you have an authentic history of the vehicle, its resale value increases and in turn the total cost of ownership decreases. And you can build on this and you can say, I want to embed in this passport the recycling terms of this product. And this helps manufacturers with EPR compliance, extended producer responsibility, which is getting stronger and stronger with consumers waking up and asking enterprises to produce proofs that this is a sustainable product and it supports recycling, and governments increasingly asking companies to submit EPR compliance proofs. The product passport is a good fit for those solutions also, because you are now creating the shared, auditable, verifiable history of the vehicle, not only at birth, but in usage and then in death, right? So that is what we mean by cradle to grave. This is just the beginning. There are multiple things that you can do once you have a shared data between multiple companies. We are working with customers which are exploring completely new revenue models where they're actually selling this data, of course, with the consent of the customer where needed, but monetizing this data directly by sharing it with other entities who might want to derive value from it. Companies are also converting their products into services with such product passports by building pay-as-you-go models, right? So several examples where we have been using MarketSend. A platform like MarketSend combines permission and public blockchains. It is built on permission blockchains to enable the creation of these cross-enterprise digital platforms that we talked about, and that enables the creation of B2B groups. But then we also have this bridge which connects to public blockchains to create the enterprise NFTs and product passports that I was talking to you about, right? Solutions like these are now hosted on the cloud. The technology has matured enough so that you don't need to think about where will this network sit, which cloud will it support, how will I use it. These things are now available as SaaS. They are hosted on the cloud and they are ready to be integrated with traditional ERPs and CRMs out there, right? Some use cases of where we have used it, we have deployed it with one of our customers, Hindalco, where they have used it to track inventory, orders, products, and invoices in their supply chain. And you can expect 50% reduction in your procurement processing time by using solutions like this. We are working with a customer in Chennai to enable agri-finance at a much higher convenience and cash flow rate for building networks between financiers, corporate buyers, and suppliers of food grains like FPOs. And finally, one example where it is being used for data monetization is a company that we are working with in Korea, where the private blockchain is being used to connect banks with fleet operators and driver organizations. And this leads to new kind of revenue models for customers. So as you can see, once you can think about a cross-enterprise blockchain scenario, then applications galore. You can think about applications in supply chain, where you enable shared visibility, where you can share this data now with banks to access capital by treating this data as an asset. You can automate your reconciliation process to ensure that the SLAs that you negotiated with your partners are insured using smart contracts. In finance, we see applications in the ability to reduce the risk for the lender, enable new kinds of financing, for example, deep tier financing, not just for the tier one supplier, but also for the tier two supplier, and offering flow-based financing, again, converting data into an asset which can be used to build a risk model and enable flow-based financing. And finally, passports, the idea of enterprise NFTs or passports which can be issued for products or drivers or even digital assets that the enterprise might hold. Several applications become possible once you start thinking about cross-enterprise digital platforms. So wrapping this up, we talked about what a blockchain is. We saw that a blockchain is fundamentally a ledger of verifiable, auditable transactions. It can also be thought of as a contract enforcement engine. Why is it important to digital enterprises? Well, it becomes the fabric for B2B transactions and data sharing. You can think of platforms like MarketSend, which use blockchain technology to enable B2B collaboration and B2B partnerships and B2B networks, applications in supply chain, finance, improving customer experience with things like product passports and compliance. How is a blockchain different from a traditional database? Well, keep in mind one of the fundamental properties of blockchain, and that goes back to where this technology was born. This is a shared ledger between multiple enterprises. It is an auditable ledger because everything is digitally signed. And those two things really transform the way you think about data and contracts. Where can you think about in using your organization? Think about where do you work with partners closely, whether it's suppliers, channel partners, bank, who have you. So when you think about this world, you need to think about business networks. Another hint of this, wherever you see fragmented and slow processes where emails and PDFs and Excel sheets and documents are being sent back and forth across enterprises, that's the place you want to think about technologies like this. And finally, where you need contract enforcement and you see a lot of time being spent in reconciliation of payables and receivables between enterprises is yet another place which should trigger your thought about maybe a blockchain would be a good fit. So this is the key takeaway for this audience, perhaps. Think of blockchains when you need to build cross-enterprise digital platforms where you want to work closely with your business partners, enable data sharing with them, enable smooth workflows across multiple organizations. That is where you should think of permission blockchains, and that is where the transformational impact for your organization can come from. If you have any questions, please do not hesitate to reach out to me at my email address and my phone number, which is mentioned here. And feel free to check out our website, marketsend.com, for more about what we do. Thank you.